Mortgages are usually the largest financial commitment in our life, and they can last for decades. And month after month, the interest that we pay quietly adds up. That's why refinancing and repricing is so important, as they can help us save a ton of money. However, if you are not careful, that could also lead to higher fees, longer debts, or penalties that you didn't expect. In this video, we will walk through when you should refinance your loan, what to look out for when refinancing, and some useful tips to make sure you actually save money in the long run. But first, what exactly is refinancing and repricing? To put it simply, refinancing simply means switching your home loan from bank A to bank B, while repricing means you continue staying with the same bank, but you switch to a new package. The reason you want to do so is simple. You want to save on interest law. However, there are some key differences between the two. First up, the fees. When you refinance your loan from bank A to bank B, the new bank will usually charge you around $2,000 to $3,000 in legal and valuation fees. Though, if your loan amount is big enough, typically more than $250K, the bank might help to subsidize some of these fees to attract you over. On the other hand, repricing is usually cheaper. Your existing bank typically charges an admin fee of about $500 to $1,000. Though sometimes, if they really want to keep you around, they might even help to waive off that fee entirely. Besides that, the second difference is the process. When you refinance to a different bank, there is a lot more work involved. You will need to dig up some documents lah, be at home for the valuers to come and visit and value your home lah, then head down to the lawyer office to sign some paperwork lah. On average, the whole thing takes about 3 months to complete. On the other hand, repricing is much simpler. All you need to do is pick a new package with your current bank, sign the offer letter, and think you are done. Usually, all this can be done within a month. Speaking of refinancing, one thing that can really save you a lot of time and headache is using a mortgage broker. And one of them is Cashew.sg. So instead of having to manually dig through different bank websites or spending hours calling hotlines just to ask for rates, with just a few inputs, Cashew helps you compare the best loan packages across multiple banks, all in one place. The best part? This service is completely free. There are no hidden charges or sneaky fees involved, because Cashew earns its commission from the banks, not from you. So you get all the benefits without paying a single cent. And if you ever have questions, their AI chatbot is surprisingly handy. Whether you want to chat for loan rates, understand the fine print, or just get a bit of refinancing advice, the chatbot is there to help. It's like having a friendly mortgage consultant on standby 24/7 without the awkward sales pressure. To top it all off, Cashew is currently offering exclusive cash rewards for my viewers. Depending on your loan amount, you can get anywhere from $100 to $3,500 back in cash when you refinance through them. So you are not just saving on interest, you are literally getting rewarded for it. Check out Cashew.sg using my link down below to see how much you could save today. So then, when should you actually refinance or reprice your loan? The most common time is when you are out of your lock-in period. That's because most bank loans in Singapore come with lower interest rates during the lock-in period. But once that period ends, the interest usually goes up by quite a bit. For example, here you can see that for the 3-year fixed rate option, during the lock-in period, the interest is only 1.78%. But from the 4th year onwards, if you don't do anything, they will raise the interest rate all the way to 2.47%. So if you don't want to keep paying that extra interest, then you might want to start looking around for a cheaper loan. On the flip side, there are also times when it is a bad idea to refinance. The first one is, of course, when you are still in your lock-in period. If you try to refinance during the lock-in, the bank will slap you with a penalty of around 1 to 1.5% outstanding loan. That could easily wipe out any savings that you would have gotten. Another bad time is when you are planning to sell your property soon. In that case, refinancing won't make sense, as you will end up paying penalty fees when you redeem your loan. Though, there are loans available that come with a redemption fee waiver when you sell your property. And of course, this should go without saying. If you are already on one of the lowest rates in the market, or if your bank offers you a repricing deal that beats the competition, then don't refinance lah. Duh. Now, while there's no limits to the number of times you can refinance or reprice, one thing you need to take note of is the minimum loan amount. Most banks will require you to have at least $80,000 to $100,000 outstanding loan before they will even consider your application. So if your loan is already smaller than that, then refinancing or repricing may no longer be an option. At that point, it might be better to just pay off the loan instead of dragging it out further. Besides that, when refinancing to another bank, you should also factor in legal and valuation fees. These typically cost around $2,000 to $3,000, while banks often waive these fees for loan amounts above $200,000 to $250,000. Smaller loans usually don't qualify, meaning you have to pay out of pocket. In such cases, these fees can make refinancing less worthwhile as compared to simply repricing with your current bank. Next, by default, the maximum loan tenure that you can get is 30 years for HDB flats and 35 years for private properties. But for private properties, whenever you refinance or reprice, you can choose to either shorten or extend your loan tenure up to a maximum of 35 years or until you reach the age of 75, whichever comes first. Do note though, the years you have already served are deducted from the maximum. For example, if you have already been paying your loan for 5 years, the longest you can extend to is 30 years and not 35 years. Some people prefer to shorten their tenure as it lets them save on interest. For example, if you have a $300,000 loan at 2.6% interest, switching from a 25-year loan to a 20-year loan cuts your total interest from about $108,300 to $85,000. That's a savings of $23,000. Though, of course, your money repayments will go up in return. On the flip side, others may choose to extend their loan tenure as this will help them free up their cash flow. For example, extending a 25-year loan to 30 years will lower your money repayments by about $160, but you will pay an extra $24,000 interest. So what some people do is they first extend their loan tenure to tide over tough times. Then, once their finances improve, they refinance the loan to shorten the tenure and cut down on the total interest. Last but not least, your age also plays a big role in how much you can refinance. If your loan tenure exceeds 30 years, or if your loan tenure plus your age or the couple's average age goes beyond 65, the maximum LTV drops from 75% down to 55%. Basically, the government doesn't want you to owe so much money when you become old apek or old amala. So, for example, let's say your property is valued at $500,000. You are 35 years old and your remaining tenure is 25 years. If you refinance, your maximum LTV is still 75%, which means you can borrow up to $375,000. But if you are 50 years old and wants to refinance with the same property, your LTV cap drops to 55%. So you can only borrow $275,000. But then, is it better to go with a fixed rate loan or floating rates? With a fixed rate loan, your monthly installments will stay the same throughout the lock-in period. This will give you peace of mind because no matter what happens to the interest rates in the markets, you already know exactly how much you'll be paying every month. The downside is that fixed packages usually start at a slightly higher rate as compared to floating. So you are basically paying a small premium for stability. On the other hand, a floating rate loan is usually cheaper at the start. In Singapore, these are commonly pegged to SORA or fixed deposit rates. If market rates drop, your monthly installments will also fall, which is great. But the catch is that if rates go up, then your repayments will climb up too. So you are taking on the risk of volatility in exchange for potential savings. Now, I know this feels like I got say but never say. So here's something a little more useful. To predict where rates might go, many people will look at the Fed's dot plot. It is basically the Fed's own projection of where they think interest rates will be in the future. And according to the latest dot plot, the Fed expects rates to gradually come down over the next couple of years. Besides that, another key indicator people look at is the 2-year US Treasury yield. 2 years because it reflects the market's expectation of where the Fed funds rate will be in the near future. So if the 2-year yield is high, it means markets expect rates to stay elevated. But if it starts trending lower, it suggests that the market believes cuts are coming. And right now, the 2-year yield has already been coming down, which lines out with the view that rates are on the way down. But here's the problem. Both the Fed and the markets have been wrong many times before. And it's not because they're stuck at a job, but rather it's because the future is always uncertain and there will always be unforeseen events, such as an inflation surge that refuses to cool, a sudden global crisis, or unexpected economic shocks that can flip the outlook overnight. When we look at long-term historical data, current rates of around 1.6% to 1.8% are already close to the lower end rather than the high. This means there's limited room for rates to fall further, but potentially much more room for them to rise again if surprises occur. That's why some argue that now might be a good time to lock in fixed rates while they are still relatively low. Ultimately, even the best projections can turn out to be wrong. So the key question is, what matters more to you? If you want a peace of mind, then go for fixed rates. But if you want to YOLO, if you prefer flexibility, then go for floating. And if you really can't decide, why not both? Some banks such as DBS even offer 2-in-1 hybrid loans, where part of your loan is fixed and part is floating. That's where you get some stability while still leaving room to benefit if rates fall. Okay, here's another question. Given that bank loan interest rates are now lower than HDB loans 2.6%, is it a good idea to switch over? On paper, the answer may seem obvious. If you refinance from an HDB loan to a bank loan with say 2% interest rate, you immediately save thousands of dollars on interest every year. But in reality, the decision isn't so straightforward. That's because HDB loans come with a level of stability and flexibility that bank loans simply don't. For one, HDB's 2.6% rate is pegged to the CPF ordinary account rate, and it has stayed the same for decades. There's no lock-in periods. You can make early repayments anytime you want without any penalties. And if you ever run into trouble repaying, HDB offers multiple safety nets. For example, you can apply for a reduction or deferment of your monthly installments for up to a year, or even suspend mortgage interest for a year under the Homeowner Job Support Program. On top of that, you can also extend your loan tenure to the maximum repayment period to reduce monthly installments. So HDB is actually quite chill in that sense. Bank loans, on the other hand, look attractive because of their lower interest rates, but they come with strings attached. Most bank loans lock you in for 2 to 3 years, which means if you want to refinance, repay early, or sell property during that time, you face a penalty of about 1 to 1.5% of your outstanding loan. And once the lock-in ends, the interest will usually go up. So you either accept the higher rates or go through the refinancing or repricing process all over again, while incurring fees each time. And what if you can't repay? Unlike HDB, banks don't give much leeway. They'll stick closely to the contract. So you might face late payment fees, extra default interest charges, and if you still can't pay, the bank could eventually take legal action and it might lead to foreclosure. Though, some banks do offer short-term relief measures like temporary installment deferments, but these are limited and usually still accrue interest. So, when does it make sense to switch from a HDB loan to a bank loan? I guess if you are confident in your income stability, comfortable with the hassle of refinancing every few years, and are okay with the fluctuation in interest rates, then switching could save you money. But if you value flexibility and peace of mind and don't want to stress out about penalties or sudden rate hikes, then sticking with HDB's 2.6% might not be the cheapest option, but it's definitely the safest. Moving on, here's another common question. Given that rates are currently going down, should you wait a little longer before refinancing to try and get an even lower rate? Here's the thing. Banks usually offer their best rates upfront to attract new customers. So whenever you refinance, the package you are seeing is usually one of the most competitive deals available at the time. Waiting doesn't guarantee that you'll get a much better rate later. In fact, sometimes the difference is much smaller than you might think. Then there's also the risk of doing nothing. Once your lock-in period is over, your loan will usually go to a higher rate, and over time, it can quietly eat into your savings. So here's an example. Let's say you have a 300k loan and your loan interest has gone up to 2.5%. Suppose you decide to wait 6 months and after that, you manage to lock in a rate of 1.2%. In this very good scenario, waiting would indeed pay off. You end up saving around $3,000 in total interest over the next 3 years as compared to refinancing at 1.8% today. But what if rates only fall to 1.6% after 6 months? In that case, the savings would shrink drastically and you will save around $400. However, if rates don't fall at all, or worse, gone up, then you would have ended up paying more interest for nothing during those 6 months of waiting. So yes, while waiting can lead to extra savings, it all hinges on how far rates actually drop, if at all. That's why instead of trying to perfectly time the bottom, it is often better to ask, does refinancing now already give me meaningful savings? If the answer is yes, then perhaps waiting may not be worth the risk. And remember, refinancing isn't just a one-time deal. If rates continue to fall in the future, you can always refinance again once your lock-in period ends. Okay, finally, here are a few quick but important tips that you should know when it comes to refinancing. First, don't wait until your lock-in period has already ended before you start shopping around for new loan packages. That's because all banks require you to serve a 2-month notice period before you can port your loan over to another bank. So if you only begin the process after your lock-in ends, you'll be stuck paying the higher interest for no good reason. So try to start your refinancing search 3 to 4 months before your lock-in expires. This will give you enough time to compare packages, get approvals, and avoid paying unnecessary interest. Second, always read the fine print carefully and don't just sign anyhow. Pay close attention to the clawback clauses, undisbursed loan rules, and any hidden fees. For example, if your bank gave you legal or valuation subsidies when you first sign your loan and you refinance too early, you might have to pay those subsidies back. Third, don't look at refinancing purely from the interest rate angle. Take a step back and look at the whole picture, including refinancing fees, locking flexibility, and even potential synergies with the bank's other products. For instance, some banks offer bonus interest on your savings accounts if you take out a home loan with them, which can make the overall package more attractive. In short, refinancing isn't just about chasing the lowest number you see on paper, but with a bit of planning, careful reading, and big picture thinking, you can make a big difference in how much you actually save. Anyway, that's all for this video. Hope you found this useful. Like, share, and subscribe as I'll be posting new videos every week.